And welcome back. Hope you guys are having an awesome day, and thank you so much for joining me in today's video because I have a lot to share. So this CPI report for September was just released this morning, which is October 13th on Thursday. This is causing a lot of havoc amongst the markets regarding the stock market and of course the bond market as well. And the bond market, of course, affects the housing market because it impacts mortgage rates. So in today's video, I'm going to share an update regarding mortgage rates, which, by the way, have surged to a new 22-year high, which is absolutely insane. The highest rates we've had since the year 2000, which is pretty remarkable here. I'm going to be sharing how that's impacting current home buyers right now, but also going to be sharing the latest update from Realtor.com. They just announced their latest housing market update today. And just like I do in my other videos, I'm actually not going to be sharing their analysis. Instead, I'm going to be looking at their data and sharing my own analysis because, of course, I'm a housing market data nerd, right? So anyways, let's go ahead and dive right in. And I apologize for my voice. I'm sick. My whole family got sick. We have a cold, so hope you guys can look past my nasally voice today. In any case, here's what I want to share with you guys today. This is on CNBC as of today. They say that CPI index for September came in at 0.4% increase for the month. That's more than the estimate of 0.3% from the Dow Jones. And therefore, on an analyzed basis here, inflation's at 8.2%. So in other words, this inflation report came in hotter than expected, and that's wreaking havoc amongst the markets right now. So at 8.2% right now, and this can mean that the Fed's going to be more aggressive for future rate hikes this year. And the Fed's meeting 2 more times this year. So take a look at this. Because the inflation report was so hot, look at this. The probability for a 75 basis point rate hike in November, actually on November 2nd, is at a 96.5% probability. Therefore, as of today, it's almost certain that the Fed's going to be increasing rates by 75 basis points when they meet in 2 weeks and 2 days from now. That's the 40% rate. But look at this. Yesterday, I actually made a video regarding this as well. Yesterday's probability was 79.8%. And because this hotter than expected CPI report was just announced this morning, that caused the street to expect the Fed to increase rates by 75 basis points by now a 96.5% probability, and only a 3% probability that the Fed's going to increase rates by 100 basis points. What's interesting enough as well, for their last meeting of this year, this is the FOMC meeting by the Fed, which controls the federal, when they make decisions regarding the federal funds rate. For December 14th, which is our last meeting this year, the probability for an increase up to 4.75% is 57% right now. So if the Fed increases rates to 4%, they're going to be increasing rates to another 75 basis points by a 57% probability. And therefore, this happens, this could cause mortgage rates to increase further. And have a look at this. The yield on the 10-year US Treasury note is sitting at 3.9%. Up very slightly compared to yesterday by about 3 basis points so far as of today. But when the CPI report was released this morning, which was released at, I think it was 5:30 a.m. Pacific Standard Time, 8:30 Eastern, the yield surpassed 4%. So the yield actually skyrocketed, and that caused the average 30-year fix, according to the Mortgage News Daily, for people with exceptional credit, of course, increasing to 7.20%. And by the way, this is the highest rates we've had since 2000. In other words, this is a 22-year high for mortgage rates. And looking back 1 year ago, rates were at 3.18%. So in other words, rates have increased over 4 percentage points in 1 single year. So here's the impacts regarding home buyers right now regarding this giant spike in mortgage rates, which is mind-blowing, given the fact that rates on August 1st were 5.05%. Now they're 7.22 or 7.2%. Absolutely insane. Anyways, here's the impacts regarding current potential home buyers looking to buy a house right now. Because, of course, number one would be a lack of buyers' purchasing power, because if rates increase 4 percentage points, that decreases buyers' purchasing power by about 40%, which is just mind-blowing. Let's have a look at the average monthly mortgage payment 1 year ago compared to today, when we take into account the median sold price 1 year ago compared to now, and of course rates 1 year ago and also rates compared to right now. So 1 year ago, the median sold price according to Redfin was $344,000. That's a national median sold price. 1 year ago as well, rates were at 3.18%, excluding insurance and taxes, because I just want to share how the impacts regarding rising rates impacts monthly mortgage payments here. So the P&I payment based on this scenario right here, would be $1,187 per month. However, though, fast forward 1 year, the median sold price $368,000 at 7.2%. The new payment would be just under $2,000, $1,988 per month. And by my math, that's an increase of $811 per month to buy a median price home today versus 1 year ago. In other words, that's a 68% year-over-year increase. I'm sharing this with you guys today because this giant increase in mortgage rates is really going to cause havoc amongst our housing market and our economy as a whole as well. So the stats I'm sharing in today's video regarding Realtor.com's latest housing market update is probably going to get worse in the months ahead because of rising mortgage rates and, of course, a giant decrease of housing affordability. But here's the latest trends or latest update from Realtor.com that was actually just posted today, the 13th. But again, because I'm a housing market data nerd, I didn't even read this update from Realtor.com. Instead, just like my prior videos that I make on a weekly basis here, I actually look at the actual data and provide my own analysis regarding what we're seeing in our housing market right now. So if you go to Realtor.com/research/data, and then click on this link right here, it takes you more or less to this data right here, which I have kind of not changed, but I've color coded and also provided my own analysis regarding median listing prices, active listing count, which of course is housing inventory, new listings, days on the market, as well as the share of price reductions and also the number of price reductions as well. So here's the source again. If you guys want to take a look at the actual data itself, but here's what I'm seeing in our housing market. And again, this could get a lot worse given the fact that rates are at 7.2%. 1 year ago, they were at 3%, just over 3%, which is, it's not mind-blowing. Can't believe that rates are over 7%. Anyways, also today, I forgot my power cord for my computer, so I'm hoping that I can finish this video in time before my power runs out of my computer. So anyways, if I'm talking fast, that's probably why. So here's what we're seeing right now for the week ending October 8th. So the median list price across the United States right now is 13.3%. That's the percent increase in the median asking price compared to 1 year ago, right? And for 3 consecutive months, we've been seeing this being flat. So the gains we've been seeing is at 13.3% compared to 1 year ago. I'm guessing this is going to likely decrease in the months ahead, given the fact that rates are at 22-year highs right now. Let's look at active listing count, though. This is the number of houses listed for sale compared to the same time period 1 year ago. So for, what is this? For 15 consecutive weeks, we've been having gains in the range of 25% to now about 30% for active listing count. In other words, an increase of housing supply compared to 1 year ago. But look at this though. For what is this? 1, 2, 3, 4 consecutive weeks, we've had an increase of active listing inventory. In other words, we're seeing more houses listed for sale compared to the same time period 1 year ago. And the big significance regarding this is, take a look at this right here, because we've been seeing double-digit declines of new listings for 2 consecutive weeks. So even though we're seeing this huge pullback of new listings, in other words, we're not seeing enough people list their houses for sale and down by double digits for 2 consecutive weeks now, even though we're seeing that, inventory has been actually rising for 4 consecutive weeks now. This is telling me that home buying demand is decreasing even greater than it was just a couple months ago, because even though we're seeing not enough houses being listed for sale, inventory is still rising. And again, this increase of inventory is likely due to a pullback in home buying demand. So compared to last week, we had a 31.4% increase of active listings compared to the same time period in 2021. So 31% gain, which is in line with what AltosResearch.com is reporting as well. Let me just share that with you right now. Right now, for the 7-day average as of October 7th, they're reporting we have 561,000 houses for sale, and 1 year ago, we had 426,000. So by my math, that's an increase of 32%, which is in line with what Realtor.com is reporting, a gain of 31%. Okay, that's housing supply. Let's talk about new listings, because for 14 consecutive weeks, we've seen fewer new listings hitting the market compared to the same time period 1 year ago. And again, for the past 2 weeks, this has been decreasing by double digits, down by 14.9% this week and down by 17.2% last week. And again, despite the fact we've had 14 consecutive weeks of fewer new listings hitting the market, active listings or housing supply has been increasing for 4 consecutive weeks. One thing I want to mention regarding this is that if we saw a huge increase of new listings every single week for a long-term trend here, this would be a big trouble for our housing market. So the decline of new listings compared to 1 year ago for 14 consecutive weeks has been more or less the saving grace of our housing market. And our landscape of our housing market would look a lot different, actually a lot worse, if we had a giant increase of new listings. And by the way, this decrease of 14.9% in the number of new listings is on par with what Redfin's reporting as well, because Redfin reports averages over the past 4 weeks. And so for the 4 weeks ending October 2nd of this year, they're reporting new listings down by 17.7% on a year-over-year basis. And yet, here's another trend we're seeing right now in our housing market, because for 11 consecutive weeks now, it's taking longer for home sellers to sell their houses. So for the most recent week, which is October 8th, of course, it's taking about 7 days longer to sell a house compared to the same time period 1 year ago. And one thing I want to mention regarding this is that this is a lagging indicator because this is based on houses that have actually closed escrow. So 7 days is the median days in the market for houses that actually have closed escrow. In other words, what our housing market was like 1 to 2 months ago. So because of our seasonality of our housing market, because we're approaching the winter months when our housing market gets a little bit slower, that coupled with the fact that rates have increased greatly to 7.2% at the time of this video, I'm guessing that the number of days in the market is going to be increasing in the months ahead. And here's another trend I anticipate will be increasing in the weeks and months ahead as well, because the number of reduced price listings on a year-over-year basis has increased by 86%. This is a huge increase because last week it was 68.3% right here. So at 86% right now, this is not much lower than the year-to-date highs that we saw in mid-June all the way until mid-July this year. I'll definitely keep you posted regarding this because if this number continues to skyrocket, that'd be an indication that home buying demand is decreasing greatly and or overzealous home sellers. Also, according to altosresearch.com, the share of reduced price listings is at 42%. So approximately 42% of the houses listed for sale right now have already reduced their asking price. Compare that to 21% in the middle of May. So in other words, the share has more or less doubled over the past 5 months. One thing worth noting here is that the rate here has been increasing ever since September of this year. So let's have a look at that right now. Here's the share of price drops on their website here. So the share of price drops according to Altos is at 42%, 41.9% to be exact. 1 year ago, it was 29%. In 2020, it was 26%. And pre-COVID, it was about 37%. So the share of price drops right now is at least a 3-year high. But look at this. The share of price drops, as you guys all know, absolutely skyrocketed once we hit April. But once we hit August, the share of price drops more or less kind of leveled off a little bit. But in September, that rate has started to increase once again. I know that was a lot of information to share, so I want to share a summary of today's video here regarding Realtor.com's update here. So inventory. Inventory has been rising for the past month and rose by 31% last week compared to 1 year ago. The growth is significant given the fact that there has been fewer new listings from last year for 14 consecutive weeks now. In contrast though, we would be in big trouble if the number of new listings were absolutely shooting up greatly. This would wreak havoc on our housing market here, but we're not seeing that though because we're seeing double-digit declines for 2 consecutive weeks in the number of new listings. That's number one. Here's number two. Mortgage rates have been at or above 6% ever since the 1st of September of this year. This should slow down home buying demand further in the weeks and months ahead. And of course, I'll definitely keep you posted regarding that. Average rates are at 7.2% as of today, which is according to the Mortgage News Daily at the time of this video, which is 11:30 on the 13th. This is a 22-year high, and rates have increased 215 basis points since August 1st of this year, when rates were just above 5%, which is absolutely mind-blowing. Also, average mortgage rates have increased by 400 basis points from 12 months ago, which is absolutely mind-blowing as well. Number three, we're seeing a huge increase in the number of reduced price listings, up by 86% last week. Also, the share of price reductions across the United States has more or less doubled over the past 5 months, according to Altos. And also, the number of price reductions is likely to increase in the weeks and months ahead due to surging mortgage rates. And lastly, number 4, it's taking longer for home sellers to sell their houses now for 11 consecutive weeks now. Again, though, this is a lagging indicator, though, because this is based on houses that actually have closed escrow. And again, I expect this to increase in the months ahead due to the seasonality of our housing market and also due to a spike in mortgage rates. And with that said, please comment below your biggest takeaways from today's video. Also, if you guys got any value in this video whatsoever, then please hit the like button. I greatly appreciate that. Hope you guys have an awesome day and look forward to seeing you on the next video.